All right, welcome to the Explainer. So, have you ever stopped to think about what makes a dollar worth, well, a dollar? Today we're diving deep into this huge, invisible system that literally sets the price for every single currency on Earth. It's a market that quietly affects everything you buy, and we're going to break down exactly how it works.
Okay, so to get our heads around this, let's kick things off with a real-world economic thriller. We're talking about the case of Turkey's currency, a financial mystery that had the entire world watching.
This right here is the Turkish lira. For a long time, it was the money of a seriously booming economy. But then, well, something went horribly wrong, and its value just went into a complete free fall.
Get this, between 2008 and 2023, the lira lost a staggering 94% of its value against the US dollar. I mean, just imagine having $100 in your bank account, and then you wake up one day to find it's now worth just $6. That is the scale of the collapse we're talking about here.
By late 2022, things got even crazier. Inflation in Turkey just exploded, hitting a 25-year high of 85.5%. The cost of everything, food, gas, you name it, was just skyrocketing, and people's life savings were practically evaporating into thin air.
So that brings us to the big question. How does something like this even happen? How can a nation's money basically just self-destruct? To figure that out, we need to zoom out and look at the global stage where all these currencies are bought and sold. To really solve the mystery of the lira, we have to visit the scene of the crime, if you will, the foreign exchange market.
To put it simply, this is the global marketplace where all the world's currencies get traded. Think about it. When Toyota sells a car in the US, they get paid in dollars. But they can't pay their workers in Japan with dollars. They need yen. Well, this market is where that swap happens.
And believe me, it is absolutely essential. Without the foreign exchange market, international trade would literally grind to a halt. You'd see companies having to barter goods, like trading cars for computers or oil for grain, just like in ancient times. It's the silent engine that keeps the entire global economy running.
Now, you've probably all seen a scene like this. A little booth at the airport where a tourist is swapping cash for their vacation. But that is just the tiniest tip of the iceberg. The real market is this vast digital network where trillions, with a T, of dollars are changing hands every single day.
So how does this massive system, which people usually just call Forex, actually work in the real world? Turns out it's not just for big banks and tourists. It's an absolutely vital tool for all kinds of businesses. Businesses really use the Forex market for four main reasons. First, they've got to convert payments. That's our Toyota example again, turning US dollars into Japanese yen. Second, they need to pay their international suppliers, like an American company needing Malaysian ringgit to buy computer parts. Third, it's used for short-term investing. A company might park some spare cash in a foreign currency if it offers a better return. And fourth, well, the fourth is speculation, and that's basically just betting on which way a currency's value is going to go. But, and this is a big but, here's the catch. Currency values are never stable. They are constantly moving up and down, which brings in this huge element of risk. I mean, a super profitable deal you signed today could suddenly turn into a massive loss tomorrow, all because the exchange rate decided to shift.
All this volatility turns the Forex market into a pretty high-stakes game. But businesses aren't just sitting ducks. They actually have some pretty cool tools to manage all that risk, and sometimes even turn it into an advantage.
So there are really two main ways to trade currency. On one hand, you have the spot rate. That's for exchanging money right now on the spot. But then you have the forward rate, which lets you lock in an exchange rate today for a transaction that's going to happen in the future. It's basically an insurance policy against those wild market swings.
So let's see how that insurance policy works in the real world. This whole process is called hedging. Let's say an American company needs to pay a Japanese supplier in 30 days. The big worry is that the dollar might get weaker, which would make their payment way more expensive. So what do? They use a forward contract to lock in today's rate. Now it doesn't matter what the market does. The company knows exactly what it's going to pay. Poof, the risk is gone.
But where some people see risk they want to avoid, others see a big opportunity. Speculators aren't trying to insure against risk. They're running right toward it. They make these massive bets on which way a currency is going to move, hoping to score a huge profit. It's a really high-stakes gamble that can pay off big time or lead to absolutely catastrophic losses.
Okay, so now that we've got a handle on the basics, exchange rates, risk, inflation,
let's circle back to Turkey and finally solve our mystery.
Here's the crucial point. The lira's collapse was no random accident. It was the direct result of what's been called an unorthodox economic policy. See, standard economic thinking says to fight inflation, you raise interest rates. Well, the government did the exact opposite. They kept rates super low. This flooded the economy with cheap money, which sent inflation through the roof. As the lira's value just cratered on the forex market, imports got way more expensive, which only pushed inflation even higher. It was a brutal, vicious cycle that completely wiped out investor confidence.
The story of the lira is just such a powerful, real-world example of this quote in action. The collapsing currency totally crushed businesses that relied on imports. But on the flip side, it made Turkish exports incredibly cheap for the rest of the world. These fluctuations can literally redefine the economic fortunes of an entire country.
And that leaves us with one final thought. You know, this global money system might seem really abstract and far away, but its effects are right there in your wallet every single day. The price of your gas, the cost of that imported bottle of wine, even the price of your next vacation. It's all connected to this constant, invisible dance of the foreign exchange market.